Hi everybody. On 10th of March, 2023, Silicon Valley Bank, 16th largest bank of America collapses. This news has shaken the whole world. After the crash of Lehman Brothers, the Silicon Valley Bank is the second biggest failure. The question is, why did this happen? How this will impact the world? Chapter 1, Money-Making Models of Banks and Startups. Let us understand Silicon Valley Bank saga, while understanding the two money-making models. Bank makes money mainly in three ways. Number 1, by giving loans to peoples, companies, and other banks. Number 2, by providing services such as mutual funds and insurance and charging people for annual maintenance, credit cards, etc. And number 3, by selling securities such as bonds, bills, certificate of deposit. Here we need to know two types of security hold till maturity and available for sale securities. Banks can have retail deposits or bulk deposits. SVB, though, had all bulk deposits. Money-making model of startups. Startup takes money from banks as loans. They get returns from the capital invested, i.e., capital gains. Third, their money comes from customers. And most importantly, venture capitalists. Chapter 2, Zero Interest Policy and Rise of SVB Bank. To start with, let us focus on loans. When would people or companies want to take more loans? Yes, it would be when the interest rates are lower. But who sets the interest rates? And why would it be set on a lower side? The central bank of any country sets the interest rates. In the United States, in March 2020, during the pandemic, the federal funds interest rates were almost near zero. The interest rates are lowered to this extent usually during an economic downturn or a recession in order to increase the money supply in the market. This is also called a zero interest rate policy. During this period, borrowing money becomes cheaper, which encourages businesses to take loans on a minimum interest rate, which in turn increases the borrowing and spending there by stimulating the economy. While this looks all amazing, wait a minute, there is another side to this story as well. When businesses or people take a lot of loans at near zero interest rate, it increases money supply. Everyone then is willing to spend more, increasing the demand. As a result, the prices of commodities increase. This eventually leads to inflation. Now between 2019 to 2021, during COVID pandemic, startups were able to raise a lot of funding from venture capitalists. Hold on, where do venture capitalists get all this money from? Venture capitalists raise a huge VC fund with money from institutes, governments, and limited partners. Through this huge VC fund, many startups are funded. Next, when the startup's valuation is pumped, then all the investors make profit by selling their stake. In 2020 and 2021, startup valuations and their stock prices were sky high. Now, where would the startups keep all the excess cash raised through this process? Yes, they would either invest it or deposit most of the excess cash in a bank that provides higher interest rate. In the years of 2020 and 21, because of the Federal Reserve's near zero interest rate policy, the interest rates were as low as 0.08. These couple of years proved to be excellent years for the Silicon Valley Bank to attract deposits, as this meant that they could borrow money from the Federal Reserve at very cheap interest rates such as 0.08 and yet make decent profits by providing 2.33% interest, rate higher than the average rate of 1.76% in the United States. Believe me friends, 2.33% interest for a startup that would deposit hundreds of million dollars is a big deal. This insane additional revenue would assist them to run their businesses. This is how SVB Bank succeeded in attracting multiple big customers who deposited millions of dollars in the bank, leading to 3 times rise in deposits. Deposits of SVB Bank increased from $62 billion to $189 billion. Chapter 3, Investments of SVB Bank. Now, just like startups, even banks invest excess cash, like we understood in the money-making model of a bank. Silicon Valley Bank now had to find a way to rotate millions of dollars such that it could generate at least 2.33% returns on $100 million so that they can provide the higher interest rates of 2.33% as promised. Lending all this money as a loan to other customers on higher interest rate was not an option as the deposits were huge. In an effort to put the money received as deposits to work, like all banks do, SVB walked straight into a huge trap. What would be a safe and stable instrument to invest in, the bank thought. The answer turned out to be long-dated U.S. Treasury bonds and mortgage bonds. SVB exactly did that. But this time it was not the same. This time unable to loan the money ahead and instead investing in long-term bonds lead to something called as asset liability mismatch. The bank invested majority percentage of $189 billion in this case, $91.3 billion in held-to-maturity securities and $26.1 billion in available-for-sale security. They also kept $13.8 billion as cash remaining amount they disbursed as loans. Chapter 4: Impact of Rising Interest Rates on Bonds. Remember, one of the downsides of near-zero interest rate policies we discussed earlier was it leads to increase in the supply of money. This is exactly what happened post-pandemic, and of course the Russia-Ukraine war together led to an inflation and overheated economy in the US. Now the goal of any central bank such high inflation scenario is always to curb the rising inflation, for which the interest rates are increased. By the end of 2022, repo rate of US has hiked up to 4.375%. Repo rate is the interest rate at which the central bank of a country lends money to commercial banks. Now, as the repo rate was increased, commercial banks were getting loans at high interest rates. Banks now also increased their interest rates. Due to this, the startups, which used to take loan from banks, now they started taking less loans. There is always an inverse relation of interest rates to bonds. Because of an increase in interest rates, the present value of bonds started decreasing. Now, although the value of the bonds in which SVB had invested billions of dollars dropped by $15 billion, and the yield was meager at just 1.6%, this was again just a notional loss. All this loss is on paper. This is a notional loss or unrealized loss. That would only convert to realized losses if SVB Bank decides to sell. Like we saw in the money-making model of startups, two main income streams for startups is to take loans and get VC funding. But during this high interest rate environment, startups could not take loans from the banks, and VC funding diverted towards the newly issued government securities as the risk-reward equation was good. All was good until now, as the losses were not realized losses. Chapter 5: Asset Liability Mismatch and Collapse. Now soon the nightmare turned reality for SVB Bank, as startups in a cash crunch had to withdraw their deposits. Now remember, the cash with Silicon Valley Bank was very less, but the demand of cash was getting very high. As SVB had invested $90 billion in held-to-maturity securities like we saw earlier, now to meet withdrawals from customers, they were in an urgent need of cash. Like we saw, most of their money was stuck in long-term bonds though. To meet this high cash demand, they were forced to liquidate the money they had invested in long-term maturity bonds. This is where their unrealized losses now became realized losses on their balance sheets. Soon this news became public, spreading panic that led to mass withdrawals. Even the big investors who were bulk depositors withdrew large deposits as high as $150 million and $400 million US. This had a significant impact on the bank. Due to no liquidity when depositors took out their money, the tenure of their deposits, in this case, liabilities for the bank, were shorter than the long-term tenure of banks' assets. In this case, the long tenure bonds led to asset liability mismatch. This panic was enough for people to withdraw money from other banks too. That's why SVB collapsed on March 10th, and on March 12th, Signature Bank collapsed. Now, do all these things happening in the United States of America impact us? We must understand that whenever anything related to inflation happens in the US, there are always layoffs. Many companies are directly or indirectly affected, which pushes their focus on cutting costs, and one of the easiest ways is to fire employees. So, to some extent this may impact us. Will this also impact Indian banks? In 2008 crisis, due to RBI's resilient policies, the impact on Indian banks was less. Similarly, even today, as per experts, it is unlikely that there would be a big impact on Indian domestic banks. One of the reasons for this is that the structure of the banks in the US are different than in India. In India, deposits mostly comprise of household savings and categorized as retail deposits, while in the US deposits are mainly corporate or bulk deposits. If you liked the video, please like and subscribe the channel. so that you never miss such informative videos.